Okay, let's be real. 401k, IRA, Roth, traditional. Does it ever feel like the world of retirement savings is just this alphabet soup designed to make your head spin? Well, you are definitely not alone. But what if I told you it's actually way simpler than it looks? Yeah, feeling overwhelmed is totally normal. But the good news, there's a really clear path through all that jargon. I want you to think of it like a ladder. So, in the next few minutes, that's exactly what we're going to do. We're going to climb that ladder one rung at a time and turn all this confusion into a straightforward, actionable plan for your future. So, here's the game plan. We'll kick things off with the 401k. Then we'll level up to IRAs. After that, we're going to tackle that big tax question, look at some pro moves, and then finally, we'll get into the rules for actually getting your hands on your money. Sound good? Let's get climbing. All right, first rung on the ladder, the 401k. Look, if your job offers one of these, this is almost always ground zero. This is where you start building that retirement nest egg. So what exactly is a 401k? Simple. It's a retirement plan your employer sets up for you. And the real beauty of it is that it's just easy. The money comes right out of your paycheck before you even see it. It makes saving totally automatic. Now, listen up because this is the most important part. The employer match. If your company offers one, and many do, it is literally free money. I mean, think about that. Where else can you get a 100% return on your money, like instantly? Nowhere. It's a no-brainer. Okay, so once you're putting in enough to get that full 401k match, and you have to do that first, it's time to climb to the next run, and that's the IRA, which stands for Individual Retirement Account. So what's the big difference here? Well, with an IRA, you're the one who opens it. It's not tied to your employer. And that means the whole world of investments opens up to you. Stocks, bonds, funds, you name it. You get way more control and flexibility than with the limited menu in a typical 401k. Now, you can see here that 401ks let you stash away a lot more money each year. The limits are just plain higher. But here's the key thing. You don't have to choose one or the other. If you're eligible, you can actually contribute to both the 401k and an IRA in the same year. All right, this next part is huge, and it applies to both 401ks and IRAs. It's the big one, traditional versus Roth. And really, it all boils down to a single question. Do you want to pay your taxes now, or do you want to pay them later? I love this analogy. Do you want to pay tax on the seed or on the harvest? Think about it. With a Roth, you pay taxes on the small seed money you put in today. But with a traditional account, you pay taxes on the big harvest you have years from now. With a Roth, that entire harvest, all the growth, is yours, completely tax-free. Let's break that down. With a traditional account, you get your tax break right now. The money you put in can actually lower your taxable income for the year, which is great. The catch? You have to pay taxes on every single dollar you take out when you retire. A Roth is the complete opposite. You put in money you've already paid taxes on, so, no tax break today. But the payoff is enormous. Your money grows and grows, completely tax-free. And when you're ready to use it in retirement, you don't owe the IRS a single dime on those qualified withdrawals. So, how in the world do you choose? It really just comes down to a bet you're making with yourself. Do you think your tax rate will be higher or lower when you retire? If you expect to be in a lower tax bracket later, maybe because you're earning less, traditional could be your best bet. But if you think your tax rate is going to go up, man, a Roth could end up saving you an absolute fortune. Okay, let's climb to the top of the ladder. We're talking pro moves now. So what happens if you're a high-income earner and the government says, sorry, you make too much money to contribute to a Roth IRA? Well, don't worry, there are some really clever workarounds. See, the IRS puts these income limits on who can contribute directly to a Roth IRA. But, and this is the important part, there's a loophole. There are no income limits on converting money from a traditional IRA into a Roth IRA. This little trick is the famous backdoor Roth IRA, and it's shockingly simple. Step 1, you put after-tax money into a traditional IRA. Anyone with earned income can do this part. Step 2, you just convert that money over to a Roth IRA. That's it. It's a two-step dance that gets you around the income limits. And if that's not enough, there's the Mega Backdoor Roth. Now, this one depends on your 401k plan's specific rules. But if it's allowed, you can contribute a ton of extra after-tax money way beyond the normal limits and then convert that into a Roth account. It is an incredibly powerful strategy for getting a huge chunk of money growing tax-free. Okay, but let's be clear about something. All of these accounts, every single one, are designed for the long haul, for retirement. So what happens if life happens and you need that money early? Well, you got to know the rules of the game. The big, scary number you need to remember is 10%. If you pull money out of a 401k or a traditional IRA before you're 59 and a half, the IRS is generally going to slap you with a 10% penalty. And that's on top of the regular income taxes you'll owe. Ouch. But there are some important exceptions to that rule. So for both 401ks and IRAs, they'll waive that penalty for certain major life events. We're talking things like a permanent disability, really big unreimbursed medical bills, or even for expenses related to the birth or adoption of a child. And then some exceptions are specific to the type of account you have. IRAs, for example, tend to be a little more flexible. You can take out money penalty-free for things like higher education or even a down payment on your first home. 401ks have their own special trick, though, the rule of 55. It lets you start taking withdrawals penalty-free if you leave that job in or after the year you turn 55. Whew, okay, we have covered a ton of ground, so let's bring it all home. What should you actually do with all this information? Well, here is a super simple 3-step strategy that experts often recommend. Step 1, put enough into your 401k to get the full employer match. Always, never ever leave that free money on the table. Step 2, after you've got the match, switch gears and fully fund your IRA, whether it's a traditional or a Roth. Step 3, if you still have money left over to save, which is awesome, go back to your 401k and keep contributing there until you hit the maximum. And there you have it. We've climbed the retirement savings ladder, and hopefully that alphabet soup is looking a lot less confusing now. You've got the roadmap, you know the rules of the game. So the only question left is, what's your next move?